Hi, I'm Sam, and I want to tell you all about invoice finance and factoring. And along the journey, this might even help your clients. Did you know that SMEs account for 99% of UK businesses, and 46% of them experience some form of cash flow problems? Late payment debt stands at around £30.2 billion a year. 30 to 150-day invoices should really be a thing of the past, but it is estimated that 1 million of the 5 million UK businesses don't know about invoice finance or what it can do to help businesses. Therefore, having a solid grasp on the invoice finance market is a must. We want to help explain some of the concepts behind invoice finance and factoring, should it ever be helpful or useful for you to explain to your clients. It is important to help clients who may have customers that have extensive payment terms. Sometimes the easiest option may not be a bank loan or an overdraft. Invoice discounting, receivables purchasing, factoring, and other similar terms are used interchangeably in the market. It is important to have a proper understanding of what is needed and where to go to. At Trade Finance Global, we work with professionals and help companies find debt funding. We're impartial, flexible, and work with most funders on the market to ensure SMEs really do get the most appropriate source of funding to help them grow. This session focuses on purchases or discounting of invoices or receivables from the client of a company. So, what do we offer? In a nutshell, we offer business finance solutions through our network of lenders to companies. This video covers receivables finance, which is one type of debt finance. So, what's happening and how do invoice factoring and discounting differ? Firstly, we'll cover factoring. Factoring is present when a business assigns their invoices to a third party and the factoring company has full visibility of the sales ledger and will collect the debts when due. The customer has knowledge that the invoices have been factored. This is the typical route a lot of funders offer. However, some can offer confidential factoring. Factoring gives businesses up to 90% prepayment against submitted invoices. This enables improved cash flow and reduces the need to wait for payment. The company may receive their invoices up to 2 days after invoices are sent out. Many factoring companies will offer to send money the same day or by backs, which is free. A business can choose a selective factoring or invoice discounting facility, dependent on the funder. Typically with invoice discounting, the customer won't know that an invoice financier is involved. Again, like factoring, there is the option to do this on a completely confidential basis. Invoice discounting is an alternative way of drawing money against the invoices of a business. The businesses retain control over the administration and their sales ledger. Invoice discounting usually involves a company reconciling with their invoice financier monthly. The main difference between factoring and invoice discounting is that with factoring, a funder will have full visibility of your sales ledger and maintain this by chasing debts on your behalf. Invoice discounting, on the other hand, allows you to keep your credit control in-house, but as we already spoke about, it would require monthly reconciliation with the invoice financier. Naturally, management fees for invoice discounting are usually a lot lower. However, a company must demonstrate that they have the correct procedures in place to support an invoice discounting facility. Why use it, and what are the advantages of invoice finance? The funder can assist in managing your sales ledger and credit control processes. Only the value of the customer's outstanding invoices are used to improve the cash flow of a business. As the business continues to grow, working capital might be needed to support this growth, which can be realized from invoices. Working capital grows in line with sales and improves the flexibility of a business, possibly allowing it to accelerate growth. Invoice finance is incredibly diverse and can be used in many different industries and sectors. Now, let's talk about the technicals of invoice finance. Here, I'll cover interest rates, what happens if there are existing finance arrangements in place, and I'll explain what security might be needed. So what's interest rate and how much is advanced? Rather than waiting 30 to 90 days, an invoice financier can pay most of the invoice amount up front, and the interest rate is the amount charged for this service. Interest rates are often linked to base rates the bank will pay for borrowing money, such as LIBOR, as well as a management fee. At first instance, the invoice can advance around 90% of the invoice amount upfront, whether that be through invoice discounting or factoring. Once the invoices are paid by the end customer, the rest is paid, excluding interest rate and management fees. What if the company has a bank loan? Even if the company has existing finance arrangements, such as an existing bank loan or overdraft, invoice discounting or factoring may still be okay for a business to use. Normally, a lender will analyse the business prior to implementing a factoring or invoice finance facility. They may audit the financial records of the business and list the approved customers. The decision is down to legal and contractual implications such as security and bank mandates. What about security? There are often guarantees that might require when a company gets invoice finance. Personal guarantees from the directors are usually required as standard. Most invoice financiers will insist on an all assets debenture over the company. Additional security may be required based on the financials of the business. What are the most important charges? With invoice finance, it is important to understand the various charges that could arise. I'm going to cover the main four. Firstly, there are discount charges. They work like bank interest and are usually around 1.5 to 4% over the base rate. The charge is usually applied on a daily basis and applied monthly. There are often credit management fees. These cover administration costs for the management of credit. The value will be relative to turnover, the volume of invoices, and the number of customers a business may have. It's usually 0.75% to 2.5% of turnover. Invoice discounting fees cover the fees to run the facility and are usually lower than factoring, ranging from 0.2% to 0.5% of turnover. Then there are credit protection charges. Charges are in line with the level of risk. This depends on whether the factor takes on the risk of bad debt, but we'll cover this next. It can range from 0.5% of turnover to 2% of turnover. Within factoring, there are two types, recourse and non-recourse. Recourse factoring means that the factor, or lender, generally does not take on the risk of bad debts. In non-recourse factoring, they do take on the risk of bad debt, meaning it's more expensive as the lender takes on the bad debt risk. Specified risks around the debtor's failure to pay are accepted, but there is no insurance against unpaid debts due to genuine disputes. So what's needed for invoice finance? There are three parties involved directly in invoice finance: the funder, who purchases the invoice or receivable, the business or customer, who sells the invoice or receivable, and the debtor, who is required to pay for the invoice. A percentage of funds are then advanced against the value of that invoice. What's the usual criteria for invoice finance? Invoices should be sent to a business, raised on credit terms after the goods and services are delivered, and agreed as payable. As an example, a wholesaler sells £25,000 of equipment to a high street chain every month. They are rapidly growing and they want to buy in more stock and employ more staff in order to continue growing at a fast rate. The company waits to be paid by each customer on either 60 or 90-day payment terms. By using an invoice discounting facility, they can receive around 90% of the invoice value soon after submitting and can continue to grow their business. Thanks for listening to this talk on Invoice Finance by Trade Finance Global. Be sure to check out our other training videos which will be sent to you soon. Please do not hesitate to get in touch with the Trade Finance Global team on info@tradefinanceglobal.com if you or your clients have any questions.